called on the government to reduce the stimulus it is pumping into the economy. We didn't say have no stimulus. We never said that. We actually offered alternatives all the way, but we said they are spending too much money. And the danger is that it's going to have a negative impact on the economy as Australia continues to grow. It will, firstly, push interest rates to a higher level than they should be at. There is no doubt about that. And monetary policy has played a key role in the recovery. There's no doubt about that. Bear in mind, and I'll talk a little bit about this later, Australian cut in interest rates has been more dramatic than any other country in the developed world apart from New Zealand. 425 basis points cuts. And the big issue in Australia compared to the US, many other jurisdictions, is most Australians have variable interest rates. So as the RBA states, the transmission indicator, the flow-through, is immediate to so many Australian households when there is a reduction or increase in interest rates. And that's why that was one of the key factors in why we have been able to survive the economic downturn. The government, by refusing to tighten fiscal policy, even though gradually a number of commentators are joining the coalition and continuing to call for a slowdown in the spending spree, the government, in refusing to tighten fiscal policy, is going to have a negative impact on the economic recovery. Indeed, the Reserve Bank is flagging now that it will increase interest rates. And certainly the markets are factoring in an increase in the rates of at least 150 basis points by the middle of next year. And the question is, why would the Reserve Bank, with still minor, small growth, economic growth, why would it be racing to increase interest rates, which in Australia are already amongst the highest in the world at 3%. Why would they be racing to do it? Because there is so much stimulus being rolled out from a fiscal perspective. And why would the Reserve Bank want to make it harder to access money? The first interest rate rise is expected to come before the end of this year. And some commentators are now flagging before the end as early as next month. The Reserve Bank has signalled it will increase interest rates to what they call normal levels, somewhere around 5.5% to 6% by the end of 2011. This will add at least 3% to current mortgage and business interest rates. That translates to increased interest payments of around $9,000 a year on a $300,000 mortgage. It's a very large increase, after-tax money for people. I might add, a lot of business people have told me that they didn't get the full benefit of the 425 basis point reduction in interest rates. In fact, many of them said at most they had a reduction of around 1% in the interest on mortgage, on business overdraft accounts and so on. But certainly you can rest assured the banks will increase them on the way up. The second effect is that higher interest rates will push up the value of the Australian dollar, higher than what it would normally have been. And this will, of course, hurt Australian exports. It will reduce the A-dollar revenue from overseas sales. It will increase the cost of Australian exports on overseas markets, making us less competitive at exactly the wrong time. It will constrain our export sector. And one of the industries that I previously was responsible for, the tourism industry, knows this better than most. Thirdly, the government's uninterrupted spending binge will need to be financed through continued heavy borrowings in the domestic and international capital markets. We believe that this runs the very real danger of leaving insufficient funds for private borrowers by crowding out the private sector. This will mean that homeowners will find it more difficult to purchase or renovate their homes, and businesses, particularly small businesses, will find it more difficult to borrow, to invest, to grow their businesses and to create jobs. And I just want to make this point as an aside. Large business can always raise capital on the markets. Small business can't do that. In the last economic downturn, major economic downturn in the early 1990s, there were probably around 500,000 small businesses in Australia. Today there are over 2.5 million. Those 2.5 million small businesses can't go to the capital markets, to the ASX. They can't go and raise additional capital. Often they're putting their own homes on the line. And if they can't access money like big business, and if they can't borrow money, perhaps like a homeowner, they're going to find it very difficult and very expensive during the economic recovery. Now, various supranational bodies over recent months have issued warnings on the potential costs of continued deficit spending. A cautionary note was most recently issued by the chief economist at the IMF, who said, and I quote, "As large deficits continue, debt sustainability comes increasingly into question. And with this comes the risk of higher long-term interest rates, both because of anticipated crowding out of private borrowers by government borrowers and because of a higher risk of default." And I'm watching China in that regard very carefully, where there has been a massive expansion of credit, and now there is quite an argument about the contraction of credit and the looming risk of defaults. Excuse me. It is our contention the government has put the budget into deep structural deficit, and this is supported by estimates of the structural budget balance in the May budget paper. Budgets which are actually structurally imbalanced can be repaired through the operation of the economic cycle, and such balanced budgets will be in deficit in times of weak economic activity and will return to surplus and repay debt in times of above-trend economic activity. But budgets which are structurally in deficit, that is, where the deficit in the downtimes has been much larger than required by the cycle, as this government's budget certainly is, are much more difficult to repair. In such cases, the budget can only be brought back to surplus and the debt repaid through a conscious tightening of policy. Now, tightening fiscal policy can only be achieved through three mechanisms. It can be, firstly, achieved through reduced spending. And as I've already noted, this government seems reluctant to take any hard decisions to cut spending. Secondly, it can be tackled through asset sales. You know what? There's not much left to sell, although I do issue a word of caution about Australia Post going into insurance, but that's for another time. Or thirdly, the budget can be repaired through higher taxes. A government can raise additional revenue by increasing tax rates or introducing new taxes. Additional revenue can be raised through stealth by removing tax breaks and benefits, therefore widening the tax base. And I have a strong suspicion that this government is planning to introduce new taxes or increase tax rates to help them fund the spending spree. Now, why would I say that, you say? Why would I say that? Well, let's have a look. Federal Labor has been here before. Labor governments increased the corporate tax rate in 87-88 and again in 95-96 to help tackle debt levels which had risen to high levels as a result of their spending. And in this episode, since the 2008 budget, the government has introduced new revenue-raising measures, such as an increase in the luxury car tax from 25% to 33%, changes to employee share schemes, removal of concessions on fringe benefits taxes, changes to the depreciation period for computer software, the denying of individuals of tax deductions for a whole range of different things, and tightening the exemption for foreign employment income. And you know what, there, I haven't even mentioned alco-pops and a range of other things. The Coalition has asked this government to come clean on its tax plans, and currently it's hiding behind the Henry Review. Let's wait until the Henry Review is completed. And the Treasurer said it's a big, broad-ranging review. So big and broad-ranging that you're not allowed to have a look at the GST. So big and broad-ranging that we're going to exclude some super taxes, which would seem to suggest that its political motivations are more significant than its economic ones. And as Olivia Blanchard, the chief economist of the IMF, said in a recent article, quote, "In nearly all countries, the costs of the crisis have added to the fiscal burden and higher taxation is inevitable." IMF. We believe higher tax is not inevitable. The Coalition does not believe higher tax is inevitable. In fact, it should be avoided at all costs. And the best way to do that is to cut back on unnecessary spending. This government's response involves a number of different things: deficits, debt, higher interest rates, higher exchange rate, crowding out of private sector borrowings from capital markets, and higher taxes. the Coalition does offer an alternative strategy. Our strategy is aimed at facilitating the best possible climate for private business investment. Our strategy is aimed at achieving the lowest possible interest rates. Our strategy is aimed at minimising the government's demands on the capital markets. Our strategy is aimed at keeping taxes as low as possible. And the cornerstone of what our strategy is to try and get the budget back into surplus as soon as possible. And we achieved that in office, when we were last in office. And of course, we have already undertaken, even in opposition, a root and branch examination of all the areas of government spending, with the aim of finding savings in as many areas as possible. And I note again that the government is conducting a review through the Henry Review of its tax system, and we will look forward to the outcomes of that. From our perspective, you should always seek to improve productivity. But productivity is the end of many factors. It is primarily the result of the private sector making business decisions as companies strive to be more competitive in an environment by producing more with less. Governments can assist this process by, firstly, ensuring that public infrastructure meets the needs of a modern economy and is efficient. Roads, rail, ports, utilities, telecommunications, the legal system and so on. Secondly, you can achieve it by lowering the cost of capital. The government should not be competing with the private sector for scarce capital, especially as the economy begins to grow. Thirdly, minimising the drag from government. The cost of complying with government regulation and taxation must be minimised, and part of this is about achieving uniformity nationwide in regulation. The government deserves some credit for announcing the program, starting the program, but we wait to see any outcomes. And fourthly, promoting competitive markets. Barriers to competition must be removed. I offered a viable, credible alternative, detailed alternative to the government, proposition to the government, to get the RMBS and CMBS markets going so that there could be more competition in banking, but so far the proposal has fallen on deaf ears in Canberra. And the policy program must be focused on strong private sector investment. It must invite a growth in the economy and a return to full employment. It must seize the opportunities that are available as the world begins to grow again, as inevitably it will. And what we offer now and into the future will be focused on making enterprise front and centre of an enterprising economy, not replacing it with the heavy hand of government. Thank you very much.